In this video, I want to talk about loans to contractors. If you have a contractor that you loan money to and you're going to deduct loan payments from the payments you make to them for their services, then I'm going to show you how to handle that in QuickBooks. Now, first of all, you would need to determine whether it is a legitimate actual loan with loan documentation, or is it more of a prepaid expense where you're paying for their services in advance? So you would have to determine that first. And I'm just going to assume that you did determine that it is a legitimate actual loan to that contractor. And I'm going to walk you through how to deal with that in QuickBooks. Okay, so I'm going to view this register. And you can see here that I have a payment to Cindy Contractor from the checking account for $5,000. So I'm just going to use this as an example. This contractor was paid $5,000 as a loan, and this contractor is going to start sending weekly bills for the work that they do, and $200 is going to be deducted from those payments back to the contractor for their services. So I'm going to go to that contractor here. So you can see that expense here, and I already entered a vendor bill for $1,000 for work performed the week of January 5th. So what I want to accomplish here is this vendor would normally get paid $1,000, but because they owe the business money, to the business it's a receivable, to the vendor it's a payable. Because this contractor owes the business money, we're going to deduct a $200 payment from this $1,000. So the contractor will actually get a payment of $800 because the $200 was deducted. Okay, so there's 3 different ways you can handle this. So what I'm going to do is add a vendor credit. And I'm going to choose the receivable loan account as the category and put this as $200. Okay, so I'm going to go ahead and save and close. And now it shows that this vendor has an open balance of $800. So what I'm basically going to do is apply the $200 deduction to the vendor bill, and then I can, pay this as normal otherwise. So what I'm going to do here is just show you what I mean by that. I'm going to mark this as paid. And then QuickBooks automatically matched up this credit, this deduction of $200 with the bill of $1,000. And that gives me a net payment to the vendor of $800. And then I would, of course, enter all of my other data related to this payment. Okay, I'm going to go ahead and save and close this. Okay, so that shows a bill payment of $800. And now I'm going to go look at the chart of accounts. So that brought the loan balance down to $4,800. I'm going to view the register. You can see the original $5,000 loan minus the $200 payment. And then I'm going to look at the reports real quick, just so you can see the full visual of that situation. If I go to the profit and loss, it shows me that $1,000 cost of labor. And then if I go to the balance sheet, it shows me the contractor loan receivable of $4,800. So we're keeping the loan and loan payments off the profit and loss. The profit and loss should reflect the actual cost of hiring that vendor or that contractor. Okay, I'm going to go back to that contractor and show you a different way that I could have done that. So I'm going to delete this payment. I'm going to delete the vendor credit. And now I'm instead going to do a journal entry. So if you prefer journal entries, this could be a way to do it. Okay, so what I'm going to do is debit accounts payable. And I'm going to put that vendor name over here on the right. And then I'm going to credit the contractor loan receivable account. And I'm going to save and close. And then that shows that here on the vendor page. And then I would do the same thing. I would either schedule the payment or mark as paid. And again, it's automatically allowing me to apply this credit against the outstanding bill. And then the net payment to the vendor is $800 instead of $1,000. So I'm going to go ahead and save and close. And I'm going to go back to the chart of accounts. And you can see it had the same net effect. It decreased the loan receivable by $200. So whether you want to do a journal entry or a vendor credit, they both will accomplish the same thing. And then I'm going to go back to the vendor and just show you that last way that you could have done it. Okay, and then one last way that I could have done it, which would not be my preferred way, but I could have, instead of doing all that extra work, I could have simply changed the original bill and added a line item for that contractor loan receivable, and it would be a negative $200. And then I would save it. So that still shows the expense of $1,000, and then that still deducts the $200. And then I would, of course, schedule a payment or mark as paid. So that is another way that I could have done it as well. Although personally, I like to have separate transactions for those two separate situations, because a loan to somebody is a separate situation from paying a contractor. But that's just my personal preference. So hopefully that was helpful. If you have any questions, feel free to comment below, and thank you for watching.